How to calculate
Add
position size in
chance out.
Forex.
Position size in Forex. Yeah.
Okay, good, good. So now, look at this. He said, let's assume you have $10,000 in your trading account and you are risking 1% on each trade, right? So if you are risking 1% on each trade now, and it says you are shorting pounds, dollars, okay, at the price 1.2700. Because so looking at the graph that I have already screenshotted here, telling us that okay, because of what
Okay.
you saw here, all right, so you decided to short. Let me grab my pen so that I can draw on the screen and you can equally see. So what this is equally saying is that, because you saw this resistance zone, all right, and you felt, oh, the market would go down and you short, right? Now,
Yeah.
you said you want to risk 1% first on a $10,000 account, and also you are shorting the pounds dollar at 1.27 price, okay, because of the resistance area. Then you have a stop loss that is 200 pips away from your entry level. 200 pips away from your entry level is like saying maybe somewhere here, all right? Then, now, so the question is, how many units do you short so that you only risk 1%? So the thing is this, while you still only want to lose 1%, all right, there is a way you can increase your lot size that even if the market goes against you, you will not still lose more than that 1%. Sure, you get? So which means that you can always try to see if you can risk more by still also maintaining that same risk management of 1% that you want to risk. So imagine like saying that you are using, say you are using 1.0, all right, you are shorting with 1.0, but then your stop loss level will now move away from these 200 pips to maybe 10 pips close to your entry level. All right. So which means that you could have used 0.1, all right, okay, and still use 200 pips as your stop loss, and the market goes there to eat you, and you lose just 1%, all right, and you can still use 1.0 and your pips will now move higher, which means that your stop loss level will now come closer to your entry level. That means that comes in a case whereby you are trying to just risk it, but you don't want to lose, you don't want to exceed that percentage of risk, all right, that you could have also taken if you are looking at, using a smaller lot size, just that your stop loss will now be farther away, maybe giving a breathing room for your trade. All right. So it just depends on you. However, understanding your position size will help you to still stay on that percentage you are willing to risk and also maximize your win. So which means that even if it goes against you, you will still just lose that 1%. You will not lose more than that. But if it goes in your favor, that's a big win for you. So understanding position sizes can be of a big advantage for you, big time. All right. So let's go for that. So the question here, all right. So the question here now would now be, let me clear this away. Good. So the question here is now, how many units would you need to short to still remain to only risk 1%? So now, the formula for calculating position sizing is this: amount you are risking. Okay. So right now, maybe you can just grab a pen and a biro. You will do the calculation in accordance with your own account size. All right. So that it becomes practical. You can now implement it in your next week of trading. All right. So bring out your pen and biro. How to calculate position size. Okay. I'm also with my own pen and biro. How to calculate position size. is position size, okay, is equal to the amount you are
Give me your pen.
risking. Hello, can you hear me?
Yeah, yeah.
Good. Position size is equal to the amount you are risking divided by your stop loss times the value of the pip you are willing to lose. So the amount you are risking is 1% of your capital, right? So let's say now 1% of $3,000 account. So you are risking $30, okay? Divided by your stop loss. You want to put your stop loss. So let's say you are trading, you want to put your stop loss at say 200 pips away from entry level. All right. So that's 200 pips times what is the value per pip of a standard lot size? All right. So the value per pip of a standard lot size is $10. The value for pip of a mini lot size is $1. And the value for pip of a micro lot size is 10 cents. So if you are using 0.01, a pip when using 0.01 is 10 cents. All right. So when you are using 0.1, a pip is $1. All right. And when you are using 1.0, a pip is $10. So if the market move one like this, when you're using 1.0, that's $10. So imagine when it moves against you. So you get good. So if your value per pip now is $10, all right. Now divide, so you say 200 pips times $10. That's 2,000. All right. So $30 divided by 2,000. All right. So if you are risking 1%, okay, and you are using 200 pips, all right, times $10. So when you calculate it now, that would give you $30 divided by 200 pips times 10. That would give you 0.1, 0.01. All right. So the account size, what you will be using, your position size will now be 0.01. Do you get that? 0.01 will be your position size. Okay. Now, if you are willing to risk 2% of your account, 2% meaning $60. All right. If you do the calculation of $60 here, you will get 0.03. All right. So which means if you still want to put your stop loss at 200 pips, okay, and you want to risk 2% of your account, you are to use 0.03. Okay. Now, how do I increase my lot size and still retain the level of risk I want to bear? So look at what this thing is saying. So this means you can trade 5 micro lot size, okay, with a stop loss at 200 pips. The maximum loss on this trade will be $100, which is 1% of your trading account. Okay, so I will still share you this video so that you can watch how to calculate. It's done by one of the top guys in the FX space. All right. So how to calculate position size so that you can best understand this very well. All right. It would really help you in your risk management. So if you still want to say, okay, I want to risk 1%, all right, but I don't want to risk more than 1%, but I want to increase my lot size. So which means that let's say you now reduce your stop loss level to 100 pips. All right. So reducing your stop loss level to 100 pips would mean that you would still lose that $30 if the market goes against you. All right. But you will have the opportunity of using 0.03 lot size. So imagine when the market goes in your favor. All right. So with that, this is saying that you can risk less, okay, and be on a maximizing, be on a level that you can maximize your win. So which means that even when you do 0.01 lot size, all right, and you put your pip at 200 pips, all right, so you will still lose the same amount of when you put your pips at 100, your stop loss at 100 pips away your entry level, and you're using 0.3 lot size. Sure you get. So you will still lose that same 1%. Do you understand? So don't forget that the game of Forex that nobody will tell you is how you are able to minimize your losses and maximize your wins. All right. There are trades you take, you make $16. There are trades you take, you lose $6. Now, 16 minus 6, that is $10 still in profit for you. Do you understand? So the game is that you want to be on the winning side. You don't want to risk too much of your capital. All right. Yet you want to be able to maximize your wins. Okay. So if you have questions, you can just note it down. All right. While before the end of this session, would have a few minutes for question and answer. So let me go straight to running some market analysis. Now, can you see my chart?
Yeah.
Yes.
Good. So I'm very much of a price action trader, and I leverage so much on multiple time frame analysis because I believe in the positive approach to the economy. The positive approach in economics says that we look at what has happened, what is happening to predict what will happen. All right. So here is what has happened. Here is what is happening. The question is, what will happen in the future? What has happened in the past? What is happening in the present? What will happen in the future? So, first, on a bigger time frame, let's start with monthly. On a bigger time frame, I like to see what is going on. So sometimes I just beat my chest that regardless of how a market will draw down, this thing will go up. And I don't mind holding it for 5 days. Okay. At most times, it eventually goes back to my position. So, and that is only possible when you have larger volumes to trade with, so that you are able to stay longer in the market. Sure you get. So, here now, I start with mapping out levels of support and resistance. Don't forget, it's on the higher time frame. Key levels of support and resistance. All right. Short price action traders to look at key levels of support and resistance. All right. Now, this one is already telling me that price I want to pick a symbol that I can always let me see. Okay, price came here. Oh, how is this thing not going? Okay, let me get another. I need this. How is this circle? Circle. Where are all these shapes? I'm coming. I hope I get it. Okay. So here. Let me see if we can duplicate. Clone. Okay. Another one here. Okay. Clone. Another one here. Clone. Another one here. All right. So clone. We still have one more stuff here. Okay, sorry. Here. Now look at this. Price came here. All right. Could not break down. Okay. And price went up. Price came here. Why do you think price reversed here? Why? Because there is a previous footprint. There is an history that has to do with this price level. All right. These things are human decisions. Everything you see here is captured human decisions. So you are seeing human decision, life and direct, playing out in a candlestick format. So this candlestick is telling us the mind of traders, the mind of investors. All right. They have always been targeting this region, all right, as a region to buy. As a region to buy. See it now. 1, 2, 3. It's not coincidence. You understand? It's not coincidence. So finally, when there was so much of loss of confidence in euro, people started running to dollars. That's what you see here. People running. People started dumping their euro and buying the dollars. All right. Now, what price action it wants to tell us is this: how do we read the mind of people? How do we read the mind of investors? How do we read the mind of traders? All right. How do we read the mind of institutions? So let's see that this level became very critical, that even while price broke out, came back, went inside again. It's very difficult for price to come here and break out to say it wants to start going down just like that. No. So from the monthly time frame that we see now, all right, even if it looks like, somebody said, I saw a Twitter post that said, the month of the September euro, the rest of the year is bearish for euro. No, no, the month of the year is not bearish for euro. All right, because when we look at what the market is saying, okay, the market currently is at a support level. All right. And if you are going to look at the price action, okay, where do you think price is going next? Eh?
It's going
Yes, the next resistance zone. Price is going to the next resistance zone. So let's draw price reaction. Price comes here, goes down, maybe plays around here, okay, goes up, okay, plays around, comes here, all right, then price is now left to make decision of either breaking out, okay, or taking a break back to this place and decide if it wants to break out or not, or take a break back to this place, all right, and shoots back into this place, okay, and then moves up. Now, so what we are just charting out now is the mind of traders. We're trying to predict their mind. You see, that's why most times now we have people setting up algorithms, all right, using machine learning, okay, because the machine, having understood the pattern of behavior of humans, we now begin to predict that these people, it looks like when this thing gets to this level, they will most likely buy. All right. And that is why you see, machines are used to build models to predict price movement, because it starts reading human behavior. All right. So someone like I used to say this, say, history repeats itself. Okay. But I believe that humans repeat history. History does not just repeat itself, there is somebody behind it. All right. So humans are the one repeating history, repeating that pattern of living, all right, that pattern of thinking. Okay. I remember when Iraq and US had a very strong issue then. That was last year, prior to the COVID, or towards that COVID period. All right. People started rushing to buy dollars, rushing to buy gold, because those were like the safe havens, and gold rose like mad. I was actively trading at the time, and then I made a lot of money from gold. So that is human behavior. People will always seek for safe haven when there is war and rumors of war. You understand? So what are we looking out for? On the monthly time frame, the monthly time frame is giving a very massive bullish momentum. All right. But don't let us be swayed away by the monthly time frame, because we are not so much of a position traders that we want to be holding for months. You can decide to be, all right. You can hold trades for months. There are people who hold trades for as long as possible. All right. So let's look at this. Let's look at the weekly time frame. So the weekly time frame is giving us another clearer picture. Okay, another clearer picture. So the weekly time frame is giving us that same picture, that the price is in a range. All right, it's consolidating within this range. Okay, it's consolidating within this range. You can see it. Price is consolidating. Comes here, goes up, comes down, goes up, comes down, and now is here. All right. There are several decisions that can happen. Okay. So what are we anticipating from the market? We've seen what is happening in the long term. Now let's come to what is happening now. All right, in the recent time, because we are coming down to lower time frames to make our conclusion. All right. So if you look at the momentum that came in the last 3-4 weeks, you see that it's a bullish momentum. Okay, look at this engulfing candle here. All right, one of the interesting things about this candle is that it engulfed more than 3 candles at the same time. This candle here, it's opened here and closed here, and you can see how it engulfed all this. So if you look at it now, because definitely sellers will not want to give up, they want to see how to struggle, and you can see how much this price has held for the past 3 weeks now. It has held above the previous open of the fourth previous week. All right. Now, having held so long like this is a big sign, all right, that once we have another breakout from this place, we are up onto, some movement, like a bullish movement. Okay, so by next week now, because if you look at it now, this was the first week after this pump, the second week, the third week, none of it has ever closed below this engulfing candle. All right, that is one significance to see the momentum coming in. All right, for euros. Okay, so for next week now, what are we looking at? The distance between year and year is something. All right, but don't forget, when price opens next week, it will not just start running up. It might run up, but there's a higher probability that there will be a retest. Market will want to calm down, will want to breathe. All right, good. So I don't forget, don't make the mistake of waking up in the midnight and picking a trade. Don't ever make that mistake. Don't ever make that mistake. Always wait for 8 o'clock. That is when the London session open, and that is when you can trade. That's when you can say you want to start trading. I don't even trade immediately then, all right? And sometimes I trade when I see opportunity, but I don't trade before that time, all right? So because anything you are trading before that time might be wrong. These are Asians, that's Asian session. By the time London session opens, London is the most active with highest volume, a larger volume of the market. So London session can open and sway you off your feet. Let's go down to the lower time frame, the daily time frame. When you look at the daily time frame equally, it gives you that clear sight into what you are expecting and what you are expecting to see. So by next week, there will most likely be a retracement that might come from here, all right, down to 50% of the body of this candle. All right, always target 50%. Okay, might come down to 50% of the body of this candle and then go up here. All right, and might also from here keep going up on Monday, and on Tuesday it will come and retest this level and then pump back up again. Okay, so you, however, want to be on the winning side, all right, where you have either you enter here or you enter here. You just want to be sure that you are on the winning side and you have your risk level actually mapped out already. Now, so that is that. So let's go to lower time frame. We have 5 minutes more. Let's go to lower time frame for 4 hours. So we can equally see what is happening on a 4 hours time frame, because the smaller the time frame, the more insight it gives about what is currently happening. All right, because the smaller time frames, the smaller it goes, it's telling you the most recent actions, the most recent decisions that the market is taking. All right, and you don't want to miss out on the most recent decision that the market is taking. The news on the NF non-farm payroll on Friday was positive. So you see, that, yeah, I think the news was positive. The news was positive, or let's confirm. Because the last
dollar was weak.
Okay, dollar was, yeah. Okay, good. Dollar was weak. All right. And we saw how the market react. Okay, and it went up. Originally, on technical analysis, the market was on a bullish momentum, right? Now that the dollar is now weak, it now strengthens it. Okay. However, there is most likely going to be a retracement up to this level. All right. There will most likely be a retracement up to this level, in the market. So say 50%. Okay. Trying to see. Good. 50% of this place, of this candlestick, would most likely. Okay, it's not clear enough. Okay. So 50% market will most likely retrace. All right. So when you retrace, you want to start looking at buy opportunity. There are times market will come even as low to this level. If Monday opens, market might come as low to this level. It's only creating more money spots for you. All right. So you have to analyze the market yourself and see if it's a good buy or not. But I'm telling you that there is higher probability that market will definitely retrace. Okay. Good. One thing about the news is that even if the news was against the dollar, right, and the market was originally not bullish, okay, in 30 minutes after the news comes out and it goes up like this, it will just calm down. What you will see is a big week. So you get a big week will just be here, and then market will be showing a bearish, momentum. So you get, but because the weakness also met some level of confidence in the mind of traders and investors in the buy zone. All right, that was why you see that the bullish momentum was actually sustained. So you get. Let's go to the 1 hour time frame. I will just round up here. So it's equally these levels that we've mapped out. All right. So most of the analysis I do ranges around the 4 hours, the daily, the weekly, and the monthly. Because those ones are the significant ones. They give you significant occurrence, and activity in the market. All right. So that is that for our weekly analysis.